Hello everyone, this is Joe Seiley, partner at Davis Seiley Wealth Management. Today is January 31st, 2019, and the purpose of this video is to provide a summary overview of the materials we covered in our client educational workshop last night for those of you that may not have been able to attend with us. Let's start off by talking a little bit about the market volatility, the factors that contributed to a pretty volatile fourth quarter, particularly December. At the bottom of this slide and in the notes below the YouTube video, I'll go ahead and paste the link to the original video market update that Mark sent out on December 18th, right in the midst of the volatility, breaking down each of these issues on a more thorough basis for those of you that would like to review that. We know you were all busy with holiday and other activities and may not have caught that. But we basically reviewed then and in the workshop last night the factors that contributed to a very bumpy ride in December in both the US and global stock markets. And if you look through each of these items here, what we find is the running theme is the theme of uncertainty. We know that markets, stock markets, bond markets, other risk markets do not like uncertainty. Risk in the markets always exists. That's always part of the equation. But uncertainty, particularly when it's government-generated uncertainty, makes it extremely difficult for corporations, sectors, even individuals to plan and allocate resources in a confident manner when you have a lot of these issues just dangling. Mark and I attended a conference call recently with Dr. David Kelly, who's the chief economist at JP Morgan Asset Management, and I think he put it pretty well when he said, quote, "The biggest tax Washington levies on all of us is the tax of uncertainty," close quote. And that adequately describes many of the issues running through this slide and contributed significantly to that volatility. It's a little bit like going into the Super Bowl this weekend and trying to put together a game plan only to have the NFL organization come to you as a team several days before, informing you they're considering changing the rules, changing the length of the field, changing where the lines go, moving the goalposts, and oh, by the way, maybe changing the team you're playing against. It's impossible to put together a specific game plan and deploy your team members and your plays and so forth in an environment where you're just not even sure what the parameters or the rules are going to be, and this is not unlike that. So this is a significant fact. These are significant factors that contribute to that volatility. Let's look at a little bit of market data, and then we'll look at some economic data. And really the purpose of this is just to look at some underlying fundamental statistics. During periods of sharp market volatility, what spews out of the television and media outlets and news outlets tends to be very, very, very heavy on the negative. The more doom and gloom they can spew, the more eyeballs tend to drift to the screen, which means the more money they make by way of their advertisers. So let's just put a little context around this and see how good or bad things really are. This is the fourth quarter. Right? We all lived through this. When the market plummeted 600 plus points on Christmas Eve, hopefully most of you ignored that and were enjoying time with your family, but we did have a tumultuous December and culminating in that drop on Christmas Eve. The market has since turned, and the U.S. market is up about 12% since then as of yesterday, but we did have negative numbers, double-digit negatives in the fourth quarter for U.S. stocks, international stocks, emerging market stocks, and global real estate. The bond market had a positive quarter, a modest positive quarter, but equities across the board were unhappy with all that uncertainty and a little bit of information on slowing economic growth, which we'll get to shortly. However, if we roll that out over the past year, we do see single-digit drop on the U.S. stock market. We had a tough year in international equities. We think that'll present an opportunity for us, which Mark will talk a little bit about when he talks about asset allocation later in the presentation. But if we go back 5 and 10 years, again, this is the longest bull market on record at 10 plus years now, since March 9th of 2009, we see that generally speaking, those risky assets, those risk assets, non-cash investments, have returned healthy numbers. And so we have to put the recent sell-off really in a longer-term context to appreciate the value that these assets provide us in a portfolio. This is the S&P 500 growth chart that we show at every workshop. I think the key thing I just want to highlight here briefly and Mark will cover in a little bit more detail later in the presentation, is that these markets go up and down as they go up. We have portions of many of our allocations exposed to these bouncy assets like U.S. stocks, international stocks, precisely because over the long term, they promise the potential of a much more handsome return than cash or treasury bills, but in exchange for that, they tend to bounce up and down or are more volatile than other safer asset classes that simply won't return as much capital appreciation as stocks do. So we ride up and down, the market goes up and down as we go up, and those that are long-term investors and are patient tend to be rewarded. So it is time in the market as opposed to trying to time the short-term gyrations of the market that reward long-term investors. This is an annual return and intra-year decline chart. What does that mean? For each bar, and I've highlighted 1980, 1998, and 2003 as examples, the red dot at the bottom, the negative number, represents the lowest point in time at which the stock market, the S&P 500, declined during the course of the year before returning a positive number. So if you look to the far left, 1980, at some point in time during the course of the year, the S&P was down 17%, but actually ended up in 1980 closing out with a 26% appreciation or increase during the course of the year. Likewise in 98, the market was as low as off 19% before closing 27% up. And in 2003, like 98 and 80, a significant intra-year decline in the stock market, down 14% before returning 26% when all was said and done. So this is just a reminder that we know that volatility exists. Just because sharp sell-offs occur in a given year doesn't mean we try to dance around that. We have no way of knowing precisely what the market movements will be during a given year or longer, but we know if we stay put, we're going to be rewarded for that patience. This is the S&P chart that we just showed you, together with the purple line towards the bottom, which is the international stock market, the all-country world index, excluding the United States. And we see that while it's had a positive return and helped diversify us a bit from the U.S. market, it's really still much cheaper relative to U.S. stocks. We'll talk about this in a minute. We don't think U.S. stocks are heavily overvalued given their long-term valuations, the long-term PE ratios, but the international markets have yet to return as handsome a return for the risk that we take internationally, but also at present represent a very attractive, more attractive price point. We see that the PE as of December 31st for the international markets was 11.5 times relative to the S&P, which is trading at 14.4 times. So again, Mark's going to talk about diversification, about how we handle in our models the opportunity to rotate a little bit heavier allocation to markets like international markets when the opportunity presents itself. But again, what we don't try to do is time short-term movements and jump in and out of risk assets in the intervening periods. So how cheap or expensive or overblown is the value of the U.S. stock market given the remarkable run-up we've seen over the last decade? Right now, we're at December 31st of 2018, we were trading at 14.4 times earnings. That's the price divided by the earnings, which is a measure of how cheap or inexpensive or expensive stock markets are relative to the cash flow, the earnings they're generating. We're a little bit higher now because of the rebound we've had. But we see, if we look at this column here, this 25-year average, the 25-year running average represented by the center dotted line here is 16.1 times earnings. If we go back to 2000, we see in the heyday of the irrational tech exuberance, we were north of 20. And down at the bottom of the downturn here, we saw PEs as low as high single digits. We're currently a little over 14.4, long-term average 16.1. So we don't see evidence that there is an irrationally exuberant market overpaying for equities relative to stocks. Does that mean they won't sell off? It doesn't. It just means that in the long term, we don't have what we see are crazy valuations in stocks. How about economic data? We've heard a lot about in the fourth quarter with the volatility. Are we plummeting into a recession? Does unemployment going up, what's going to happen with rates. Let's take a look at what the real numbers tell us. Now, across the entire expansion, we see that gross domestic product, GDP, the aggregate production of goods and services in the United States over that time period, has averaged 2.3% growth per annum, which is more anemic than most expansions tend to be, between 3 and 4%. A little bit below the long-term average of 2.7%. But with the market volatility and the slowing global growth we think we're seeing, we're still not tipping over into negative numbers. We are not in a recession, and it's anticipated that we'll probably settle around 2% to 2.25% growth for the foreseeable future, 2019, 2020, barring some unforeseen shock. So we would classify this as a strong tortoise expansion as opposed to, an overheated hare expansion where we're running at 3.5 or 4% growth. Not a great number, but not a recession, not a horrible number. Slow, plodding, steady growth. How about unemployment and wages? Well, we see unemployment is well below the long run average. The unemployment rate, the average over the last 50 years, 6.2%. Right now, we see unemployment at 3.9%. We had a slight uptick, which had really more to do with people who had previously not been counted in the number, who were on the sidelines because they'd simply given up looking for work, who are now re-entering the active search for jobs, given the fact that unemployment is so low and that wages are creeping up. So we saw a slight uptick here. It's interesting to note that Dr. David Kelly from JP Morgan Asset Management, who I referenced, and I reference him because it's fresh on our mind from a call yesterday. JP Morgan thinks that unemployment will approach 3.5% by the end of the current year, 2019, and may drift towards a 3% number by the end of 2020 if we continue to grow at the rate we've been growing, which is really a remarkably very, very low number historically. So when you're an employer and you're running out of employees to hire, and you need to increase what you're offering in order to attract and retain them, that's when you start to see some of this wage pressure here. So we've seen an increase that's growing at about 3.3%, which again, given the long-term average, is still below that long run, but it is ticking up. How about corporate profits? How are the corporations doing? U.S. corporations, as represented by the S&P 500, still have very, very healthy profit margins. As you can see, the projected numbers here for the foreseeable future are still very healthy. We ended up fourth quarter, I believe, at around 14% growth on earnings, which is not as high a growth rate as we had been seeing. So the growth rate is moderating, but the growth is still occurring. So these are still very healthy numbers, and you can see record high profit margins have continued even through that fourth quarter when the stock market volatility due to other factors of uncertainty got a little crazy. So we don't see unhealthy corporations. We don't have a slide here, but if we looked at the amount of debt on corporate balance sheets, it's really in the long run at a very reasonable, modest level. How are the consumers doing? Well, we see that as far as the amount of money that they're earning that they have to throw against debt, known as the debt service ratio, it's at a long run, very low level, 9.9% as opposed to double digits at the peak in 07. How about net worth? In the fourth quarter of 2018, we had a little bit of peel off due to the stock market sell-off, but we're near a record high in terms of household net worth. That's driven by the steady increase in home values and the steady increase in portfolio values over the last 10 years. Still very healthy there. One area of concern we have compared to the consumer is the state of the budgetary affairs when we look at federal finances. We see that now we have a $4.5 trillion expenditure in the country. At the current pace, we're borrowing nearly $1 trillion a year to close that budgetary gap relative to the places where the government takes in income. And as you can see on the right here, the projected foreseeable future, we're going to be running these healthy deficits, which at some point in time has to be resolved. Normally in times of strong, steady, stable economic growth, that's the opportunity where you reduce this substantially, or heaven forbid you eliminate it and you run a surplus. That's not where we are. The Trump tax cut, while providing some stimulus for that GDP growth we saw earlier in 2018, also so far has contributed to an increase in that deficit. So at some point in time, reform is going to have to take place to close out that deficit. This is a slide we don't typically include in our presentations. We've included it here. This is exports as a share of gross domestic product. And we do this primarily to give a little bit of context on the trade feud that's raging, particularly with China. Here we see that in the United States, where we have roughly a $20 trillion economy, only 8%, and I say only 8% of a $20 trillion economy is significant, but 8% of our GDP is generated by selling goods and services abroad, exporting goods and services abroad. And we see that of that sliver, this little purple slice here is what we rely on by way of our exports to China. Conversely, China is dependent on 19% of their GDP comes from exports. 19% of their GDP generated by exports. And of that, we see that the United States is responsible for a fairly significant portion of that. So on the one hand, we might argue that we probably have a little bit more leverage with China in this negotiation due to that imbalance. We can't lose sight of the fact that in the meantime, the tariffs that are placed on the imports that come from China and other countries are nothing short of a tax. You may want to argue that they're effective political negotiating tactic to get better deals negotiated. That may or may not be true, but the fact of the matter is that the tariffs that are involved are a tax on United States citizens and are driving up the costs of anything related either to the finished good import or things like steel and aluminum and other things that come in that are used to assemble things like automobiles. So that just gives you a little bit of context on GDP and the role that exports play for each of the primary countries involved in the tit for tat here.
Hello, this is Mark Davis, partner with Davis Seiley Wealth Management. Happy to pick up this portion of our presentation from the workshop we gave on Wednesday, January 30th. Today is Thursday, January 31st. As we talk about investment principles, you've already seen now, as the presentation done by my partner Joe Seeley outlined, some of the things that are causing volatility and concern. You're seeing what the data actually looks like, how markets have actually performed. So let's now just talk about some long-term principles that allow us to be successful when we're in the investment world. First of all, we want to look at making sure that we let markets work for us. So, the phrase has been given many times that it's better to have time in the market than trying to time the market. What do we mean by that? Well, we're simply saying that over time, it's clear that stock allocations in both large cap and small cap stocks outperform by leaps and bounds other types of investments, government bonds, treasury bills, which are something we think of similar to like CDs. And this graphic, which we're showing here, simply goes back 93 years ago or 91 years ago and says if you had $1 in 1926 and you invested that dollar, how would it have grown over the years? $1, according to US inflation statistics, you need $14 today to buy the same amount of stuff that $1 bought for you back in 1926. $1 invested in CDs or short-term treasury government loans, so to speak, would have grown to be worth 21 bucks. $1 invested in long-term government bonds over that 90-plus year period of time would have grown to be worth $143. But that $1 invested in large company U.S. stocks through all the ups and downs, through wars, through depressions, through Vietnam, through resignations of presidents, through the Cold War, through everything, that $1, if it had remained invested, would have grown to be worth $7,347. That is the power of staying invested in the markets. And lastly, if that $1 was invested in small company stocks, it would have grown to be worth 3 times what it would have been in large company stocks, more than $22,000. So again, financial markets reward those who are long-term investors. That's why in diversified portfolios, we don't put every dollar in long-term investments like this, because some people have short-term investment needs or they need lower risk for whatever reason. But with that portion that is allocated to stocks, you just have to be a long-term investor with that portion of a portfolio in order to let the market truly work for you. Now, there are many risks associated with owning individual stocks, and that's one of the reasons why we have them in large funds. But there's some risk areas that we want to point out specifically with you. First, company-specific risk. If you have all of your money in one stock, that stock can make you a billionaire, as you see with people that own Amazon and Starbucks and others. It also can send you to the poorhouse. As many of us remember, Washington Mutual was, I think, the third largest bank in the U.S. before it went bankrupt during the financial meltdown. And of course, just yesterday, Pacific Gas and Electric, a multi-billion-dollar utility in the state of California, just declared bankruptcy primarily because of the recent fires that happened in Northern California and the liability that's going to be associated with them. So if you had all of your money in one stock, regardless of how great that company may be, you're bearing company-specific risk that is significant, and we recommend that clients reduce that risk. Which is why we don't own individual securities. We always own large funds of securities of stocks. Industry-specific risk. This is talking about if you put all of your money into a specific industry, whether that's the tech industry, whether it's the housing industry, whether it's financials, even industries that seem good and have been around for decades, you can have industry-specific implosions. Of course, we saw this during the dot-com era, but we also saw it during the financial meltdown where banks went under, where real estate development companies went under, where lenders of different types went under. So when you think about diversification, we want to spread across lots of industries and not be focused in just one. We don't want all of our money in gold or silver or all of our money in certain types of industries that are subject to boom and bust cycles. Next, we want to reduce risk by eliminating country-specific risk. So this is talking about having all of your money in one particular country, and that even includes the United States. We want to be diversified across a global spectrum of countries. Certainly these countries listed here below, we are well aware of the financial troubles that Venezuela is having now. Argentina for decades has been in and out of the financial doghouse as they've defaulted on debt and spent well beyond their means and had various problems in Argentina. And of course, Greece likewise has been saved really by being in the EU and having other member countries bail them out repeatedly since the financial downturn of 2008. So again, we want to reduce risk. We can't eliminate risk, but we can reduce risk by not having tight allocations to an individual company, an individual industry, or even heavy designations in an individual country. So let's just give you an example of what that looks like in practice. This is our current allocation in a model that we call our Growth and Income 9 model. We have 28% of that portfolio in U.S. stocks, but that 28% allocation is diversified across 3,000 different companies. We call our allocations Index Plus because we have a broad allocation like an index would, but the portfolios are tilted towards companies that tend to have higher earnings, tend to be smaller in size, tend to be what we call value stocks rather than growth. Likewise, on the international and emerging market side, you'll see that the 23% allocated in this particular model to international and emerging markets has more than 10,000 different company stocks in it. If you look at the bond allocation in this portfolio, you got 22% in bonds, thousands of bonds across different industries, countries, and issuers. Incredible diversification, short-term bonds, long-term bonds, high-yield bonds, high-quality bonds, really diversified holdings. On the real estate side, we have two real estate allocations, one in the U.S. and one abroad. In the U.S. allocation, we have more than 2,500 properties in that portfolio of real estate. So again, broad diversification. If one property were to burn down or blow up or an earthquake hit in some area, that doesn't take out the whole portfolio, reducing risk through diversification. And with the 5% that's in international real estate, we have 280 real estate companies abroad, each that have dozens of properties in various locales. Again, diversifying our risk, getting more consistent rates of return. And we do have 9% in alternative investments. These are investments that tend to zig when the rest of the market is zagging. Likewise, just provides greater diversification to an overall portfolio. Now, the next principle we want to talk about is not just diversification, but avoiding market timing. Market timing is something all of us are susceptible to, and most of us don't think that we're market timers. But if you ever think to yourself, man, the stock market's down, I better run and put all my money into cash, you're a market timer. Or you think, boy, that thing's really gone up, I better put some more money into it. That is market timing. What we're looking at with market timing is we're basically chasing returns. And we do not want to chase returns. You'll notice here that the higher risk assets, REITs, emerging markets, developing market equity, small caps, etc., tend to perform better, which is consistent with that mountain chart I showed you that stocks perform better than bonds. But from year to year, you have a ton of volatility. Here, emerging markets was your best performer coming out of the downturn of 2008. But of course, it was only 2 years later that it was the worst performer, down 18%. Likewise, in 2017, it was the top of the food chain, plus 37%. 2018, the worst performer. So we don't want to time the markets. We want to own diversified assets. We rebalance those assets. We like certain assets and tilt them a little bit and underweight others, but we do not market time by running everything into cash, then back into bonds, then back into cash, then time to own stocks. Let's go international, let's go emerging. That has proven to be a fool's errand, and we don't participate in that. Most important, you got to manage your own emotions. We're just susceptible to when things are running and running up and everything's exciting, markets are strong. Boy, we want to borrow against our house, borrow against our credit card, and we want to buy. When things are getting more expensive, when prices are rising and we're excited, that's when we want to buy. And that's exactly when we should be selling some of those high investments and buying ones that have performed more poorly. Likewise, when things are plummeting and when we're fearful, we think the markets are getting into trouble. Right when things are getting cheap, we don't say, gosh, this is a great time to be a buyer. That's when we say sell, put everything in cash, right before the big rebounds often happen. It was Benjamin Graham, who's considered the father of value investing, that said, individuals that cannot manage their emotions are ill-suited to profit from the investment process. So we must just stay long-term. And one of the goals that we have as a firm is to help you manage your emotions so you stay invested, you stay properly allocated, regardless of the noise that may be going along in the world, particularly in the media. I guess the key behind all of this is you build an investment plan based upon your income needs, your risk tolerance, your goals, etc. You got to stick to your knitting when things get ugly. This is a real client data. You might look at this and say, gosh, over the last 12 years, that account didn't really go up very much. You can see financial downturns and everything else. But the important thing to see here is that this account had a lot of withdrawals taken. It's a retirement income account. So while the account may have started here and had some additional deposits, this client's taken out almost $250,000 from the account, and 12 years later, the account is still very similar to its original value. So this is just a reminder that if you stay invested during the big sell-offs, and when you have another sell-off, and when you have another sell-off, if you stick with your plan, you will meet your long-term retirement income needs or other goals that you may have. And people that zip in and out rarely do. And we want to share with you as we conclude this workshop a couple of pithy little statements from people much smarter than us. These are people that are financial legends, and just want to share a few comments and help you to maybe apply these to your circumstance. First, Benjamin Graham, again, who we said is really the father of value investing, said the following: the best way to measure your investing success is not whether you're beating the market, but by whether you've put in place a financial plan and a behavioral discipline that are likely to get you where you want to go. Warren Buffett said the stock market is a device to transfer money from the impatient to the patient. And that's exactly true. People that have short-term attention spans, can't ride through the up and down volatility that stocks tend to have, don't earn the long-term returns. I think it was Warren Buffett that said, when I buy a company or buy a stock, I'm happy if I don't see even what the value of that is for the next 10 years. I'm happy to own it and go away. And that's sometimes what you have to do rather than watching it day to day, month to month. Jack Bogle recently passed away. He was the founder of Vanguard Funds and really the father of modern indexing. And he was well known as a long-term investor. He said the following: your success in investing will depend in part on your character and guts, and in part on your ability to realize at the height of ebullience and at the depths of despair alike, this too shall pass. And that really is the key. When things just look horrible, That's typically the best time to be a buyer. And when things look so good, you just want to buy, that's the time to, again, at the heights of ebullience, to take some of the profits off the table. Peter Lynch was the manager of the Fidelity Magellan fund that outperformed every other fund for about a 15-year period. A very legendary fellow said, "Far more money has been lost by investors trying to anticipate corrections than lost in corrections themselves." Because often people are pulling out at the exact wrong time, trying to check, now's the time to pull out, oh, I better pull out now. And then when do I get back in? Well, not yet. And it's just not possible to nail that properly. Jack Bogle again said, "The idea that a bell rings to signal when to get into or out of the stock market is simply not credible. After nearly 50 years in this business, I don't know anybody who has done it successfully and consistently. I don't even know anybody who knows anybody who has." So just remember, we stay invested and we do well. And as a concluding comment, Benjamin Graham said the following: "The investor's chief problem and his own worst enemy is likely to be himself. In the end, how your investments behave is much less important than how you behave." Now, our goal here at Davis Seiley Wealth Management is to help you be successful, to help you stick to your knitting, to help you build a plan that helps accomplish your goals. If your goals have changed, if you have different needs, that's a great time for us to adjust allocation holdings. But the day-to-day vagaries that occur within the markets and with the global economy and with political structures and everything else, those things have to really be set aside and left as a long-term investor to be successful. Anyway, thank you for listening to our presentation. As always, please call us if you have any questions. We appreciate your business and hope that all is well. Thank you.